All right, welcome back to another episode of the Pumped On Property Show. I think we're up to episode number 60 from the reboot now, which is pretty exciting.
Holy hell.
Getting ahead there, over a year.
Over a year. I remember cutting it back to scratch and going, oh my gosh, we're already at 60 again.
It's nuts to see, hey, but I'm really pumped about this discussion. Now, we've just finished up the podcast and got really detailed talking about the seminar that we recently went to where Phil Anderson got up and spoke for about 5 hours straight as to where we are in the current real estate cycle, how much longer we have until the top of the cycle, what's expected to happen after the top of the cycle, based on hundreds of years worth of history, based on lots of data, lots of research. It was just so exciting.
So fascinating, man. We go really, really deep into this plus previous cycles, his thoughts on what's coming next. The seminar was great, but I think the most value was the 2 hours after. You had a couple of beers with him and it was just an incredible chat where we got to really, really ask the questions that we wanted to ask, that all of you guys want to ask, and many of them are answered in this podcast. So we're super grateful, guys. Get on board. Lots of data, lots of laughs. It's a goodie. Cool, bro. So a couple of weeks ago, we've just come back from, a really good day with Phil, and then dinner and a couple of hours of just picking his brain. I had to apologise 3 times because I'm so sorry, man. I know you might not want to talk shop, but we're talking shop.
yeah, seriously. Hey, I kind of went straight to the jugular up there because I'd never had that one-on-one time with Phil myself. And I just saw him. He was chilling with his wife and business partner and sat down and just had a bit of a chat and asked about my personal situation. It was just really nice to get that feedback from somebody like him that's been doing this for decades and decades and been so successful. But it was so comforting and gave me so much confidence driving back up to the coast that night, eh?
Fully, man. There's many things that we're going to talk about in this podcast from Phil Anderson and from Simon Priestley at Propertyology that I think are going to give you massive confidence in a year where there's going to be a lot of a lack of confidence in the market. So I suppose the key takeaways, and then we'll get into all the nitty gritty, because I took so many photos on my phone and I'm just going to literally walk through slides. It's going to be a bit of a disjointed sort of podcast today because we're going to be talking through a lot of stuff.
Yeah.
But key takeaway was a couple of people in the audience. There was probably 90 people there for the day that asked, if you're a crypto guy, if you're a property guy, if you're a stock guy, what would you be doing right now? And to every one of those people, he said, it is a great buying opportunity still. Because I think one of the big questions many of us has is, after a 30% growth year in most places of Australia last year, is there still value? And absolutely, he doesn't think it's even kicked off yet.
No.
On top of it being a good time to buy in his eyes, we also got to looking at the 3 previous cycles and what the upside looked like for every capital city in Australia, as well as the downside. So we'll definitely talk about that today as well.
For sure. Some of the key takeaways that I had was just his confidence in this cycle and how it unfolds as well, because a lot of people were asking, did COVID change the cycle or does anything that's occurring around the world right now change the cycle? And basically Phil said is every single cycle is different, which is natural, because if it was the exact same, everybody would be able to forecast it, but it's just slightly different. But he said, regardless of those external situations and events that are occurring around the world, the cycle has kept on ticking. And he's like, I don't know what's going to happen in the future. Things could change, but he's putting his money on it that the cycle will continue to unfold, which gives me a lot of confidence.
Now, before we get into the nitty gritty, which honestly I'm so excited to share with you guys because there is absolute gold here. I think it's important to recognise just the timing. The second half of the cycle that we're in now, according to history, should peak at around about 25, 26. Well, he's very confident on 2026 now.
Yeah.
But it could be a year earlier or a couple of years later. That's how it's been historically. And so he mentioned that as we move into this second phase, there'll be more emotion, there'll be more conflict, there'll be more up and down years. Like, it won't be just this consistent journey like it was in the first half. And it's just, one of the things that he mentioned was just, look after your mental health, look after your spiritual health, look after your physical health as well, because it's just a little bit bumpier. The news is going to get a bit more sensationalist, a bit more boom and busty, a lot more fear, a lot more excitement. So just recognize that.
Yeah, with that volatility comes increased emotion and fear and everything like that. So he just said it's always important in the second half of the cycle to just stay on point of your mind and don't get too carried away with things, because later in this cycle, he anticipates that confidence is going to be at all-time highs, markets will be at all-time highs, and people will just think that this is never going to end. So while there's going to be volatility and it's important to, take stock of your emotions and your physical health during those times, so you are making the right decisions, but on the other hand, it's not getting too greedy at the wrong times as well, making sure that you are taking the necessary action at the right stages of the cycle and not getting too ahead of yourself as we do get closer to 2026.
I love it, bro. So I'm just going to start ripping into this because I just can't wait any longer.
Let's do this.
So the first slide that I photographed, and I've photographed way more than I was expecting to. I just want to say, Phil, I'm so grateful, man, for letting us talk about this stuff as well, because this is absolute gold.
And before we get into this as well, like, one thing that Phil said at the very beginning of the seminar is like, you go into any seminar with an economist, you are not going to hear this sort of stuff anywhere else around the world. So it was like, it was cool that there was 90 people in the room, but I feel as though there should have been 200,000 people in the room, with the amount of value here.
I'm glad there weren't. But I wish everyone knew this stuff too. Like, you've got to remember, guys, like, just because you follow our stuff or Phil's stuff or Fred Harrison's stuff doesn't mean that everybody's doing it and everybody knows this stuff. And it becomes really simple once you understand the history. But, I'm grateful. It gives you a hell of an advantage. So, the first part that he talked about, bro, which we've talked about on heaps of videos, if anyone wants to check them out on YouTube or previous podcasts where we talk about the real estate cycle explained, go have a look. But this is the 18 to 20 year real estate cycle, and he said it's broken into 4 super distinct different stages. So effectively, phase 1, the cycle begins out of the wreckage of the last one. So think the last time there was a big wreck was the GFC.
Yep.
They've called that the Great Depression, the recession we've had to have. There's it's always got a different name, but the last one was the GFC. Now, for a lot of people listening to this, you would have been too young like us to have really felt it. For a lot of people listening to this, it's like, man, like, there's a deep living memory of your stocks going down 50%, properties in America going down 30% in some suburbs. Like,
super getting hammered
super. Like, most people lost 50% and have just recovered it. So a significant downturn. Now, in the first phase, the cycle begins again. And basically what happens is the stock market understands the extent of the damage and it starts to go, well, it's not that as bad as we thought because we understand the wreckage. And the banks understand their position and how bad it is, and the governments have stepped in to bail out the banks they want to. And those poor banks that are second and third tiers that don't get the bailouts are just sort of left to clean the streets or to get rebought from the bigger banks. Now, that wreckage can take a little bit of time, but it starts to turn. Generally, what will start to turn first is the stock market.
Yeah. And, this is generally sort of some point between 2 to 4 years after the top of the previous cycle. So the most recent, obviously, top being the 2008 global financial crisis. Phil predicted a recovery and a start of the new cycle from 2012. So this is sort of roughly around 2012 phase 1 begins.
Yep. So what happens in phase 1 is come out of it and we start to get growth in stocks, in commodities, in crypto, in bonds, in
certain
property. Generally the markets around the world and the stocks that perform better, or the property markets, are the biggies, the Londons, the New Yorks, the Singapores, the Sydneys, the Melbournes, the blue chip companies that have more diversified income streams which can come out of it sooner.
And then this phase, is that the phase that runs for 7 years?
Yeah, so this is roughly a 7-year phase. It can run 5 years, it can run 8. It just depends on how things are going.
Yeah, so sort of 2012 through 2019, pretty accurate.
Fully, bro. And then we get to the mid-cycle slowdown, which is normally around about a year to 18 months. It's characterized historically from looking back at previous ones with about anywhere between a 20 and a 40% drop in stocks during that time, and somewhere between a 0 and a 15% decline in property prices around the world. That was pretty consistent with what we saw this time around as well.
Yeah, generally the mid-cycle slowdown is brought on by some highly emotional event as well. So it completely rocks sentiment. It really changes a lot. Hey, Redmond. And, that obviously unfolded with COVID. Now, Phil didn't know COVID was going to be the reason for the mid-cycle slowdown. Just like we didn't know that the war on terror, the Twin Towers coming down, was going to be the mid-cycle slowdown back in 2001. So you never know exactly what's going to happen, but generally some highly emotional event that impacts the sentiment around the world.
I love that. Like COVID, 9/11, the recession we had to have where interest rates were sitting at 17%, and then before that the Cuban Missile Crisis. There's always a reason for 7 years of excitement that people know that things aren't going to be great forever. Turns into fear. Then the market understands what's going on, things recorrect, and we get the boom, he calls it.
Which is phase 3.
This is phase 3. So the boom, like phase 1, but addition of greater economic confidence. So people are really starting to get confident. We see expansion. We see people spending money. We see the government spending money. We see credit getting easier. We see speculation and we see optimism. And they're the sorts of things that we're starting to see now. Even though in Australia, we've got interest rates coming up, we've got an election this year, and we're a bit scared of the war and the flooding. At the end of the day, once we move through this period, things are starting to look pretty positive. And if you look at the likes of America and parts of Europe right now, like it's starting to happen.
Yeah, and to have a little bit of context, let's go back in time a little bit, talk about the previous cycle. So, in 2001, we had the Twin Towers come down and the war on terror begin. And then we saw the US go into Afghanistan and Iraq, and that war ran for however many years it did. Terrible times for a lot of people. Now, and at that period of time as well, from 2002 through 2008, we saw 22 interest rate rises in Australia. We still saw 6 out of 8 capital cities double in value, which is information we got from Simon Priestley as well. So coming into this phase, there is, the hostility over there in Europe at the moment with the Russian and Ukraine war. And we've also got the talk of interest rates coming up. We always have a new election year every single 4 years. And for some reason that, does hold certain people back. So, what I'm trying to get at is this isn't new. This has happened in the past. It's just we've forgotten what happened in the past. And then these things that are coming up now are giving us sort of reasons to be a little bit nervous as to where things are at. But generally, at this stage of the cycle, it's relatively short-lived, this type of sentiment.
Absolutely. And so once we go through this phase 3 of upward growth again, and the most dangerous part is at the very top of that, where people are just going absolutely nuts, and we get someone coming on TV saying that it's never going to end, real estate's never going to decline, the stock market's never going to crash again, we've got it all figured out. Generally, that would be like an American president, or it'd be heads of business globally. Then we get what he calls stage 4, the peak, the crash, and then the eventual recovery again. We've recovered from every single major financial crisis we've had globally in the last 500 years. It just feels like it's never going to end when you're in it. Like COVID at some parts were very, very scary. You get a more severe downturn than phase 2, the mid-cycle, where he said the excesses of everything we're going to go through in the next 4 to 5 years catch up with us. People start using credit cards to buy stuff. People are all in all of their savings because the banks are loose as well for the first time in a while. People overextend at the banks. You get dodgy brokers and stuff writing loans that shouldn't be in place. And then it says we get falling asset values, pessimism, anger, reduced credit all at one time. And all of a sudden, historically, we've seen property prices in America drop about 38%. The stock market during that crash, phase 4, would be about honestly 40 to 60% drop at that time. Again, incredibly damaging if you don't understand it or see it coming or expect short-term returns on money. Incredibly good opportunity if you can be in a safe position to buy stocks at 50 cents in the dollar, knowing that for every previous cycle, they've almost doubled from that point within 3 years of the start of a cycle again.
And the thing is, at this stage of the cycle, it can be extremely challenging to access credit from the banks. So, what Phil says is basically the banks will go from being your best friend towards the end of the cycle, very, very easy to access credit, to them now being your enemy essentially, and they will not loan you money unless you're in like a very, very, very positive financial position. So that's one thing to take into consideration at that point in time as well. Knowing that if you understand this cycle and if you want to capitalize, it can be bloody hard because the banks just may not lend you money.
Honestly, we work with one of the biggest property acquisition group in Australia. Their head of buying is one of our clients, and I'm talking like billions of dollars of purchases a year. And I asked him when we caught up in person, could your group borrow money? His group couldn't borrow money.
Wow.
Phil Anderson, when we had dinner with him the other night, I said, Phil, what did you do? And he said, I was in business with a bank manager in one of the top 3 banks in Australia at that time, and she couldn't get us a loan for a year and a half.
Crazy,
I had to buy stuff with cash. So if the biggest group in Australia and investors with huge amounts of money can't do stuff, it's just the case of, well, maybe there'll be a period where you're not going to be able to do something, and you'll just have to wait 9 months, 12 months, 18 months until they're ready to start writing loans again.
Which is fine, because at this stage of the cycle, you don't generally see very positive gains. So even if it takes you a couple of years, at that point, you're probably at the beginning of another 14 years worth of up. So if it takes you an extra 18 months to 2 years to get in, it's not going to be the end of the world.
I wouldn't be stressing on it, and it's very uncomfortable to buy at that time. I found it personally very emotionally challenging to buy from I think it was about March through to December of 2020 during the COVID year. Even though I knew we were coming to a mid-cycle event, emotionally it was like, am I doing the right thing? Am I not? Very uncomfortable. It's also, what I've learned from the media cycle, which is still very negative from an event that we had that was financially managed over 9 to 12 months ago, is the fear in the market will stay for a lot longer than the market will start recovering, but the fear will last for another year and a half. So you've got a huge amount of time to take advantage of it.
And that was cool. We wanted to take it into that 10-year thing. Are we allowed to talk about that?
Yeah, we'll definitely talk about that in a sec, because there's a really good slide that I took a photo of.
Yeah, that one.
In terms of the years, that was crazy.
Yeah, so what Phil did here was, I don't think Phil actually did it. I think it was
Gann.
Yeah, it was Gann. No, it was even somebody else, because he looked at 100 years worth of performance in the stock market.
Yeah, Gann looked at 119 years and charted it.
119 years, and it was fascinating what came out of here. Essentially the performance of the markets over a 10-year period based on the year that it starts, whether it be a 2020, 2021, 2022, 23, 24, all the way up to 2029. But it was basically just based on the last 2 numbers of that. So relevant for almost every single decade for the past 100 years.
Yeah, and what they found is that years ending in 0, 1 or 2 were generally negative years or tiny increases. Years 3, 4, 5, 6s were very positive. Years 7s were normally a low. Years 8s and years 9s were normally better as well. Again, that's just charting, and then Phil charted it for longer than that too. It's just interesting to sort of see. At the start of the year, Phil said that this would be a very flat year.
Yeah.
It's going to be a very flat year, and it's just interesting that the 100 years before that, a year ending in 2 was also like that too.
It unfolded exactly as it has, and obviously 2021 was a bit of an outlier year in comparison to that, but that was looking at the stock market, and stock market, property markets are slightly different, but looking at that and coupling that as to where we're at in the current cycle, 2022, based on this information, represents one of the best buying opportunities that we'll see for potentially the next decade.
Absolutely, man. It's a very exciting time. And Simon and I just did another video on this, like why we think this and the next year are going to be two of the best buying years in the next 5. It's just incredibly, if you could see the data and the history the way that we do from having these conversations with crazy people that have been just obsessing about this one thing for 30, 40 years, like there's a lot of potential. So what I liked, because it's all well and good to have a cycle, but it's like, well, if you don't know the dates, or if the dates don't always align up, what can we look out for? So there's a great slide here called what to look out for at the peak to sort of know that we're there.
Clear as.
And he said the world's tallest, largest, biggest, anything.
Deepest, whatever it might be.
So tallest building, if you start to look around, the tallest building in the Southern Hemisphere, you were saying the other day, is expected to open in the Goldie in, 2027?
Yep, exactly.
You've also got the same thing happening in parts of America, parts of Europe, parts
Asia,
of the Middle East and Asia.
Bridges.
All expecting to be opening in 2026, 2027.
Yeah.
The reason this happens is because finance is very hard to get at the start of a cycle, and land prices are too low. When land prices get higher, it makes a thing like that more profitable, and then they can get finance from a bank. And so that's something to look out for. Plenty of that's coming at that time.
Just an example on that before you go into the next one. Back in early to mid 2000s, the announcement of the Q1 on the Gold Coast came out, and they had hit ground. They'd started building, and they were starting to sell off the plan at that point in time. Now, that at the time was Australia's tallest building. Now, that one got completed and finished in 2008.
100%, and it was empty. Like, I remember going down the Gold Coast, and it was literally empty for 5 years. And then it was only once the wreckage was cleared away that it started to resell and fill. And I think Seoul, the other huge building down there, was similar, but a little bit later.
Yeah. You know, people were buying those off the plan for 800,000 to $1 million back in like 2004, and then upon completion they were worth less than what they bought them for 4, 5, 6 years later.
You know, I've talked to clients and people that have booked strategy sessions with us, and I know this guy bought one of the penthouses there for like 1.4, couldn't resell it for 700k at the time.
Wow.
Like, it was really rough. The other thing at the peak is optimism is very high. So right now, I'd say it's an extremely bearish, pessimistic market.
Agreed.
People are shit scared for no reason except that the media has taken them that way. And it's pretty normal after a big growth year for a little bit of a, I don't know, I'll just wait and see type vibe. But optimism's very high. You know, think Gatsby almost. Like people just spending money on shit that they don't need, and opulence and cars and credit cards, and they're very indebted. Yeah,
and it's because they think that it's never going to end. Like, everybody thinks that it's been such a long time since anything bad has happened that, you know, these good times are never going to end. So people get overly optimistic. It's kind of like in sports, you know, when you have a team or a winner that's just consistently just beating everybody, just constantly beating everybody, it gets to a point where everybody's like, this is a sure thing. I can definitely bet on this and it's going to win, but all good things have to come to an end at some point in time, and then it all comes crashing down. And it's 100%. No different with the real estate cycle. It's just long enough so that people forget the previous cycle.
Completely, man. Like they say, property prices are over the top and building is frantic. So renovations, knockdowns, rebuilds, subdivisions, townhouses, people, because the land prices that they bought previously are high, everyone's trying to cash in and make money. I went to an accountant yesterday who I've never met before. Him and all of his partners are now buying property. Like, that's their business outside of accounting. Like, everybody's starting to get in because everybody's seen the gains and they want a piece of the pie. And when, you know, the people like you guys and us that are a bit earlier in the cycle, you know, then when the accountants start getting in, and then when all their clients get in because they're sharing stories about this person making this money and that, everyone becomes a developer. The solicitor I went to yesterday is now a property developer because he doesn't think he can make enough money in soliciting anymore. It's just natural for people to start following the money. You'll see some of the big businesses like your Apples, your Googles, your Teslas will start either becoming banks, issuing credit cards, or buying property, and it's like when that stuff starts to happen, we know we're getting fucking close to a peak. Then he went on to say from there, stock markets are at all-time highs or even above them, and then the yield curve inverts. Now, this is a really important one.
Yeah.
Effectively, the yield curve is so simple. It's just the Reserve Bank of Australia sets a 1-year bond rate or the cash rate, and then there's a 10-year bond rate or cash rate. And the American Reserve Bank or Reserve Bank of America will do the same. When historically speaking, the 10-year rate should be higher than the 1-year rate, because it's like I'm taking risk by parking my money for 10 years, so it has to be above what I can get in the bank today. When the 1-year rate or 3-month rate's above the 10, there's a fucking problem coming, because it's like the market is forecasting that things are going to be worse in the future than they are today. And so this inverts, and every single time this has happened, we've gone into a recession within 9 months of that inversion previously. Now, everybody knows about this, but the problem is the people that know about it, generally people like you guys that watch this stuff, and you forget that that's less than 1% of the global population.
Yeah.
And so people don't pick it up. It could be the front page of the Financial Review. The last time it inverted was 9 months before 2020.
Yeah.
It inverted in 2019. Everyone knew there was a recession coming, except the 99% of people that don't understand this stuff.
And, there was recently a yield curve inversion, but at the event with Phil, he said it was the wrong yield curve, because there's 3 different yield curves that you can look at. There's longer term, medium term, shorter term. And I believe what he was indicating is you need to be looking at the longer term bond rate. And when that one inverts, it's when things are getting a little bit shaky. So that's a really clear indication. On top of that, he also indicated at the top of the cycle, one of the first things to start recorrecting and one of the first signs to know that the slowdown is coming is the real estate investment trust, the REITs, will start to pull back a bit as well. And that is generally one of the first signs of a slowing environment, is when those REIT investments start to come back a little bit as well. So they're 2 clear things that you can see on a chart to help you understand. But what Phil was saying is you don't really want to wait until that does happen, because it's too late at that point in time, basically. So timing can be extraordinarily difficult to know the true top or the true bottom. So you just got to forecast your averages.
He said that because somebody said, well, what's your plan, Phil? Are you going to sell properties and try and cash in? And he said, no, my personal preference is to buy and hold properties, the same as Simon and mine is, for the long term.
Yeah.
He's like, there's no bad time to buy if you're buying as a 15 to 30 year investor. If you're trying to be a speculator using property, then there are very good times to buy and very bad, dangerous times to buy. So, he said that what we'll start to see next, which is crazy because of what the Labor Party said recently, is they'll try and encourage first-time buyers to come in. Then we'll start to see the banks getting looser and looser around finance because their positions look so stable. The reason their position's stable is because everyone's got equity. The value of their assets is high and the debt's a lot lower, and we've saved money. So they'll start giving more away and people start taking it. They're talking about 2.5% deposits for first-timers. They're talking about free stamp duty for them. All of that is going to create demand at the bottom. People at the bottom will move to the middle will move to the top, and it will just put a fire under this thing, and that's completely natural for this stage of the cycle.
Yeah, and the cool thing that Phil explained to us as well was, the reason that there is a real estate cycle, and there always will be, in his opinion, is because the gains are enclosed in real estate. It's quite a complicated thing to sort of unfold, but essentially, while there's private ownership of the lands and we're able to sort of invest in this type of asset, there's always going to be a cycle. And what he explains is this theory of economic rent, where all economic gains in society end up back in the land values because the land value, the gains are enclosed in the land values. And that is why we get this longer term real estate cycle. And that's why there's also these clear indicators that happen at different stages of the cycle to give you an idea as to where we are in the cycle. Now, because where we're at right now and a number of different I guess, key performance indicators that Phil looks at, he's extremely bullish that we are in the second half of the real estate cycle, that we still do have another 4 to 6 years worth of really positive times in front of us because of a number of different things that are happening around the world right now.
For sure. And like an example of that economic rent concept is in like inflation, I suppose in Australia has been 5 to 6% this year. So, that means that in certain industries, wages are going up. Like I know in certain trade-related industries, wages have gone up 50% this year. And all of a sudden, rents are going up by $100 to $200 per week this year. So it's like, cool, we've made some extra money. It means that people have got some extra money and property just creeps back up, so that a third to half of people's income is always going to be allocated to property, whether it's to their home loan or their rent. Now, this has been happening for 400 years in America, for 1,000 years in Europe and the UK, and it's always going to happen that way. We're seeing people make money in crypto, and then those guys in crypto that are making money out of thin air are coming and buying property with us. At least a quarter of the investors that we work with have made somewhere between 20 and $1 million in crypto. You know what I mean?
Yeah.
Like there's just so much money pouring out of there that was created from nowhere coming into real estate.
Yeah. I think another really cool thing to talk about was sort of the averages over the last 3 cycles as well, which is really important, because I know there's still some people listening to this going, but we've seen so much growth already. Like, how can it continue to move forward? And looking at these longer term averages based on, so what Phil looked at was the 3 previous cycles. He averaged out the 14 years of up and averaged out the 14 years of down for the 7 capital cities around Australia. And it was absolutely mind-blowing.
Mind-blowing, man. So we're talking about, 3 times 20, so almost 60 years worth of data here averaged out. For that 14 years up, the average return, and this is taking out inflation in Australia, was 131%. So almost anyone that buys at the start of a cycle to the end of it for the last 60 years has made about 131%. When you add inflation at 2% per year, it's well above that.
Yeah.
If we look at individual markets, Sydney has averaged 94%. Melbourne's averaged 200%.
That's outrageous.
Brisbane's done 130, Adelaide's done 140, Perth's done 180, Hobart's done 94, Darwin's done 130, Canberra's done 123.
Massive.
Incredible. Now, there's reasons why Melbourne's done better, because it's become over the last 60 years the second largest city in the size of Sydney, and therefore, the reason why Perth's probably good is because commodity prices have gone nuts in the upside of the K-wave, which we won't talk about today, in the last 40 years.
Yep.
And that's historically accurate. But what I love that I've never seen before is the down years, the 4 years down. So again, this is inflation adjusted for the last basically almost 60 years, 54 to 60 years. The 4 years that we go down in an economic cycle. Now, he said the Australian banking system is significantly more conservative than any other banking system in the world. We require our banks to keep heaps of cash on hand. We have very responsible lending. We, at the moment, have an interest rate adjustment 3% above the cash rate. So there's a lot of safety built into the system. And we have massive regulations for accountants, financial advisors, mortgage brokers. People still will do dumb shit in Australia, and we'll see plenty of it in the next 5 years, 7 years. But the down years, this is interesting for me because America gets wiped. Like some parts of America drop 50%, other parts drop 10%. The average drops 38%. And I was always really fearful of that. But looking at this, Sydney has dropped by 7.2% in the average GFC event. Melbourne's dropped by 11%. Brisbane's dropped by 11%. Adelaide's been 9%. Perth's been 9%. Hobart's been 11%. Darwin's been 1%. Canberra's been 7%. And the Australian average has been 8.6%. So it's sort of comforting for me. Now, that's inflation adjusted, so it could be a fair bit worse than that. You could add 8% to that.
Easy.
Easy, but it's sort of like if you've bought early enough in the cycle and not at the very, very top of the winner's curse, or if you're buying in the winner's curse, just buy the suburb that's done less than 5% per annum in the 10 years leading up to it.
And hold long term.
And hold it forever. You'll be fine.
You'll be fine.
crazy though. Like that gives me a lot of confidence that, you know, we've bought for people that have already made 100%.
Yeah.
I would happily make 100% in 10 years and lose 10% of it every 10 years, you know what I mean? Or
Yeah.
it could be worse than that, it could be better, but it made me sleep a lot better, I think.
For sure. And then if we look at the Australian market at the moment, you know, we're seeing markets like Sydney and Melbourne that have, you know, done really, really good numbers over the last, I guess, 10 years from 2012. But then you've got markets like Brisbane, Perth, Darwin, Adelaide that have just not performed anywhere close to those historic averages at this point in time. So, you know, it gives me confidence that, you know, we are where Phil says we are, and we do have a bit more time in this current cycle to capitalize on some really strong gains, and knowing that there will be a correction, there will be some form of correction. But if you get in at the right time, it could be a little bit easier to hold through those times or time it a little bit better.
For sure. And we'll talk about this. I'm actually thinking of breaking this podcast into two
parts, yeah.
Because this is the Phil stuff, and then we'll talk to the Simon Priestley stuff. Phil's the bigger picture, cycle long term, and Simon's extremely good at finger pulsing where we are right now and what could come based on history.
Yeah, and Phil's stuff is it's global. You know, he looks at the US market because that generally leads this cycle. Everything stems out from the US because it's the biggest economy in the world. Like, it's got the most amount of money, most amount of spending. So, you know, it's the biggest economy, and that's why it leads the cycle, where Simon will actually, you know, localize it. So he talks very specifically about Australia, which is what I like, and we can definitely talk about that in the next one. But, you know, to sum it up, it was extremely empowering and gave me a lot of confidence and enabled me to sleep. Actually, that night I didn't sleep very good because I was just so amped. Like, I was so on. I was so pumped up. I was just like, this is so exciting to understand all this stuff. But, you know, there is so much potential out there. I think 2022 represents one of the best buying opportunities that we're going to see moving forward. And I'm excited to see how it all unfolds. Like, I'm still a cautious skeptic, but at the same time, it's been very accurate.
It's been incredibly accurate since I've been following him, because he's doing it off 230 years of data. And then Fred Harrison, who he figured this stuff on from in the UK, it's been happening for 350 years.
You look at Gann stuff and it's even longer.
You know, there's examples of this cycle 500-700 years ago in France, you know what I mean?
Yeah.
Like, and it's just a cycle. If you just simplify it to its simplest form, it's just the movement of money and the movement of emotion around an economy.
Yeah.
So people get really excited, go too far, pull back, get really, really excited again. They go over the top, and then we get a pullback. And it's like excitement, fear, excitement, fear. Or in the movement of money, easy money, tighten up, shit, we're letting this run a bit. Oh, we've tightened up too far, we've overcorrected governments around the world, we'll let it go.
Going nuts.
Crazy again, oh shit, we've gone way too far. Break, but the break comes 2 years after it should have, and that's where we get the drama, and that's where we get the opportunity as buyers as well. Like, in terms of real terms, properties in Bondi Beach and Noosa, for example, between 2008 and 2011 in Australia, places that were worth $3 million in both locations were selling in some instances as low as 600K. Now, those properties might not have been on realestate.com. You might have had to go to the public trustee auctions. You might have had to know a solicitor or someone at the bank. But these opportunities are around. The thing that I found out personally from buying through COVID is there was about 4 months where we didn't even see a single person at one open home in Brisbane, and we didn't get a single person placing an offer because everyone went, whether I'm in a good position or not, I'm scared and I'm just going to park. And I think we're starting to see a bit of that. I'm sitting and waiting right now, and I love it when it comes through, especially when it doesn't align with the long-term cycle, because yes, this might feel scary. Yes, Sydney and Melbourne prices, after going up 100% last 10 years, might come back by 10% in the next year because the government's putting the handbrake on and people don't know what happens in an interest rate rise, which we'll talk about 50 years of that in a minute. But it's very, very exciting if you can understand the timing and recognize when there's fear in the market naturally that realistically, statistically shouldn't be there yet.
Love it, man. Thanks so much. It was awesome to go down to the seminar. Really appreciate it, Phil. And thanks, Jason, for putting that one on if you guys do stumble across this podcast. But yeah, I think that's a wrap for this one, and we'll jump into the next podcast, which will come out in a week or two.
Woo! That's a wrap. That's a wrap.
Getting
Have a
cool,
spin.
bro. Yeah.
Oh, sweaty. So sweaty. Oh, that's good. That's so nice, eh? Oh.